our client, let's say that our client is Mary Poppins. So Mary Poppins is our client. We're going to prepare her tax return. And we're going to have to prepare Schedule A, Schedule B, Schedule D, and Form 8949. All right, so we should be able to get a good amount of money for preparing Mary Poppins' return. Now, we have quite a bit of information about her. And what I want us to do first is to identify the sources of funds. So we're going to still need to determine whether or not it's income. So on line 7, we go through a number of items that the IRS considers income. But she has different sources of money. What we need to decide is this money that she's receiving, whether or not that's income. So the first thing we need to do is to identify where her money is coming from. So I made a list of these items. She received money that we could classify this way. Let's go through and identify how much money she received. So the first item, so now remember, we're just talking about, let's go through this scenario and determine how much money she received. That's what we're trying to determine. How much money did Mary Poppins receive? And then we're going to determine how much of that is actually income. So what do we know? What do we know about her salary? How much is her salary?
$75,000.
So her salary is $75,000. Now, unfortunately, she had her mom had passed away, and she received an inheritance. How much is that?
$625,000.
So $625,000. Remember, right now we're just talking about where she's getting her money. Then we're going to, once we've gotten through all these items, then we're going to have to determine whether or not it's considered income according to Congress. What about gifts? 13,000. And her mom left her $625,000, but she also had life insurance. How much was that? $300,000. And then we have some information about the stock that she sold. How much is it? Yes, 2,200. 2,500, right? The net gain on the stock sale was 2,500. What about her interest income? So she has some money in the bank, First Savings Bank. How much is her interest income? How much? $2,000. And she also received dividend income, which was how much? $1,800. And then, as it turns out, she was actually very lucky, right? Did she win a prize? how much was it? She entered into this competition at the local grocery store. And as it turns out, she won! $750. What about alimony? 15,000. Now, let me ask you this. Is there any reason to believe, based on what's shared with us here, that any of that money was for child support? No? Right? So, that's important that we make a note of that. So this is alimony, not child support. Specifically, it's alimony. And then she had money invested in a partnership. How much was her income? ST partnership.
4800.
Right, $5,300. All right, so let's get started with her return. So everybody has the 1040 there. So let's fill out her return. So our client is Mary Poppins. And her social security number is that's her social security number. 1, 2, 3, 4, 5, 6, 7, 8, 9. I expect you to keep that confidential. She's our client. All right, and let's see. Where does she live? 120 Sanborn. I know. Springfield. $60740. Okay. So it seems pretty mundane, but we have to fill that information out. The name of the client, if they have a spouse, the spouse's name, their social security number, the address. And then importantly, we talked quite a bit about this, we need to determine what is the filing status. Is the status single? Is it married filing jointly? Married filing separately? Is it head of household? Is it a qualifying widower or widow with a dependent child? Well, in this situation, it's pretty straightforward. We looked at quite a few different situations dealing with qualifying child and qualifying relative and trying to determine if the person would be head of household. But in this situation, Mary is single, right? It tells us that, that she's single. In terms of an exemption, she could claim herself, and she also has some dependents. Now, do these dependents meet the requirements for a qualifying child? What do we know about the dependents? We have Jason, and Jason's sister, June. Let's see, so we had to put in the social security number. That wasn't always on the 1040. And people would list like 15 dependents. But now you need to, if you're going to list 15 dependents, you need to provide their social security number. And the IRS will know if I claim a person as a dependent and if Janelle also claimed that same person, was able to match and cross-reference the social security number. So when you're doing the intake with the client, we need to make sure that they're clear about that. Now, if the, in this situation, the divorce decree is such that Mary is able to take the children as her dependent. She has custody of the children. So she could take them as a dependent. They could have agreed otherwise. The parents of these children could have agreed otherwise. The IRS doesn't want to get into the middle of that. Just you guys agree, and then file your return. But both the mother and the father can't take these children as dependents. Now, so what do we know? Jason is her son. How old is he?
17.
And what about the daughter?
18.
So did they meet the age test? So they're both under the age of 24, but that's not really the point here because they both live at home, right? They're not away at school. And both of them are younger than 19. So they meet the age test. And is there any other information that we know about these two siblings? So remember I had said that they have a divorce decree, and Mary, our client Mary Poppins, is able to take the dependency deduction. So Mary provides for their support. In this case, and they live with her, even though for a couple of months during the summer, Jason lives with his father. But so far, do you agree? Do you think that that June is, Mary is entitled to take these children as her dependent? I mean, regardless of what the divorce decree says, it doesn't mean that these children meet the qualifying child or qualifying relative test. It just says that the parents agreed that basically if they're entitled to a dependency exemption, that Mary, the mother, would take that, that deduction.
But the father provides most of the support for Jason, more than the mother.
So it says that Jason, let's see, right, so the father provides $10,500. His expenses for Jason are $10,500.
Thank you.
And she spent only 6,000.
They was on the summer. It says Jesus support.
But
It was on during the summer.
Right, only during the summer. So what does it say? What does it say in the code about a qualifying child? What is the test? You know that one of them is age, one of them is residence. What does it say about support?
Jason, as long as Jason doesn't work more than half of his support, should be placed.
Right, so everybody got what Muhammad said? So Jason and June are still the dependents of Mary. All right, let's see what else we know here. So she's able to take them as a dependent. Let's see, number of children that live with you. All right, so she could take herself, an exemption for herself and for her 2 children that live with her and whom she provides their support and are less than, both who are less than 19 years of age. All right, what do we know about her wages? So line 7 is wages, salaries, and tips. We have some information about that, which is what? $75,000. That's her wages. Now, all of these items that we're going to enter here are income. But the first one is her wages. All of these items are income. Now, she has some taxable interest, and we do need to provide and prepare Schedule B. Why? Because in this case, her taxable income is more than $1,500. So if the taxable interest is more than $1,500, then you need to prepare a Schedule B. That's particularly relevant in our scenario here. There's other reasons why you need to prepare a Schedule B, but in this scenario, the most relevant is the fact that she had taxable interest of more than $1,500. So her taxable interest is $2,000.
Taxable interest is 1,500.
2,000, right?
Oh, okay.
You're right, 2,000. So her taxable interest is 2,000, which is more than 1,500. So if you had taxable interest of $300, you don't need to prepare Schedule B. You just put on line 8A, just put $300.
That's the interest income.
So that
So this is what I have up here now is Schedule B for Mary Poppins. So she had $2,000 in taxable interest from First Savings Bank. And we also know that she has ordinary dividend of $1,800. What about tax exempt interest? Does she have any tax exempt interest? Yep, she does. Her tax exempt interest is $37.50. Questions so far? So we're just looking at, so far, the sources of funds for our client, Mary Poppins. She received all this money in 2012. Now we're going back and we're saying, what is considered to be income? So we know that wages, salaries, and tips on line 7 is income. That's $75,000. So she received $75,000 from her employer. And she does have taxable interest. That's what we have here on Schedule B. Now, in some cases, you might have money in 5 or 6 different banks. So if she had money in Chase, we would have to put that down. Right, so you might be wondering, like, why are all those lines there? Because what the IRS wants us to do is to list all the financial institutions. They don't want just the amount, they want to know where the money came from. And how much taxable interest did we receive from each one of those, let's say, banks. So whether it was from Chase or Citibank or TD Bank. In this case, she received the $2,000 from First Savings Bank. Okay, so that's the bank that we list and the amount. If it was less than $1,500, then we wouldn't need to fill out Schedule B. Well, it's not hard to fill out Schedule B, but we wouldn't need to do that. Questions so far? All right, so here we're just going to put down the tax exempt interest, right? Doesn't it say in our scenario that she does have some tax exempt interest, which would be interest that's from what, for example? What's an example of something that we would consider to be tax-free?
You have stocks, treasury
Bonds? Yeah, like municipal bonds. So if you have municipal bonds, or and it's paying dividends, or bonds, you're receiving interest, right? So the coupon rate that you receive is going to provide a certain amount of money to us, but we're not going to have to pay tax. In this case, she did receive interest of $3,750, but it's tax exempt. Municipal bonds is a good example. You receive interest on bonds. So we just make a note of that. You see it's on the left there. The IRS just wants to know how much money do you have in tax exempt securities that's earning interest, but that's not part of her income. But we just make a note of that there. We made a note on Schedule B here that she did receive $1,800 in ordinary dividends from Amber Inc. So we put that on line 9A.
Isn't it qualified? It's qualified.
It says qualified?
Yeah. I think that's 9B.
Okay, qualified dividend income, $1,800.
That's gonna go on 9B? No.
Non-native ordinary dividend.
Right, but you guys said it's qualified, right?
Ordinary
Yeah.
dividend, non-native.
Where does it say in the scenario?
Non,
It says qualified dividend.
Qualified dividends, income.
qualified dividend, yeah.
Okay, so Gershwin, you have a question about that?
No.
Qualified dividends, 1,800. What about taxable?
The dividend
So
is
should we take
qualified,
that
so
off
how about
schedule?
the schedule B?
Take that off schedule B.
Where I have this on there.
Yeah, that one.
Okay. Now here's one of our favorite questions. Does she have a taxable refund? Did she get money back from, let's say, the state of New York in 2012? In other words, in 2011, she paid a certain amount of income tax to New York State, but then in 2012, she received part of that money back. Do we have any indication in her scenario that would indicate that she got a refund? No? All right, so in this case, she didn't, but we looked at a number of examples where that might be the case. Why do we need to include that as income? Why would we need to include a refund as income?
Because we already did it on the year before diagnosis.
Right, so if the year before we itemized our deductions, and what that means is that we reduced the level of taxable income. But then if we got the money back, then we have to say, well, wait a minute. We reduced our taxable income by too much. At the time that we prepared the return, that was the amount that we paid to New York State. But we can't change that. That's the amount that we paid. But then, sometime in 2012, we got money back. So we're talking about the tax return for 2011. In 2012, we're suggesting that we got a refund. In 2011, that was the amount that we paid, but then they gave us some of the money back, so now we have to make an adjustment. Well, how do we reflect that? Here. Because previously we had reduced our level of income, now we have to increase it by the amount of the refund. In this case, our client, Mary Poppins, did not get a refund from New York State. So that's zero. But she did receive alimony. It doesn't tell us how much was the amount of child support, but it does specifically say that this is alimony. Why do I make the distinction? What does the code say about the treatment of alimony versus child support?
Child support is not the income.
Right, child support is not considered income, it's not taxed. But alimony is income and taxable. So how much did she receive? 15,000. All right, as far as we know, she doesn't have any income, any business income. She doesn't, we don't need to prepare a Schedule C, but we have some information about her capital gains, right? What do we know about those transactions? So let's look at this, this information that we have here about the stocks. So this same company, Amber Stock, she sells it for $20,000, but she purchased it for $24,000 from her cousin, who had purchased the stock for $26,000, and the stock was worth $23,000. So we have a lot of information there. One of the things that we need to determine is the relevant information. Previously, and this is almost hard to believe, but previously, when you received a 1099 that indicates the proceeds from sales, it didn't indicate the cost basis. But now, Congress is requiring brokerage firms, for example, financial institutions, to provide the cost basis. What is their concern? Why all of a sudden is that an issue? What do you think was happening?
Valuing the stock risk and what it really was.
Yeah, indicating that they paid more for the stock than they actually did, meaning that their capital gain is going to be much less. So now we need to fill out Form 8949. We need to fill this out before we fill out Schedule D. So the first question is, for short-term transactions, which is less than a year, right? Was the basis reported to the IRS? Was it not reported to the IRS? Or was it not reported on the 1099 to start with? So now that we're early on in this process, the IRS wants to start keeping track of, they want to know, was it that the broker didn't provide it? Or was it not reported? So was it provided on the 1099-B but not reported? Or was it provided and also reported to the IRS?
And this would be the long term.
Right, this is going to be long term. But what is it? What are we going to say here? So in this case, we could assume that for our scenario, for Mary Poppins, that it was reported to the IRS. Previously, keep in mind, the 1099 would just say the amount of the proceeds. So it would say you sold 1,000 shares at $25 a share, and your gross proceeds, so that's before any transaction fee or commission, was how much? $25,000. But that's kind of interesting. The real question that everybody wants to know is, well, if you sold $25,000 worth of stock, how much did you pay for it? What was your cost basis? Was it $1,000? Was it $2,000? Was it $20,000? Was it $28,000? So now, that information, the IRS is putting a bit of onus on these brokerage firms to keep track of that information. So in this case, we're going to say that, that it was reported on the 1099-B and it was reported to the IRS. So if your client has a transaction, if they sell stocks, one of the things that we need to do is determine their cost basis. Now sometimes, right, now going forward, we expect that that's going to be very easy because it should say it, right, on the 1099-B. It's going to say, you bought it for $18,000, you sold it for $25,000. But before that, you'd have to go through the transaction statements and try to figure out, sometimes people, they might have been holding the stock for 15 years. And they say, well, this is what I got from my stockbroker. We're part of the way there. We need to know how much you paid for the stock. Then we could prepare your Schedule D. Now we need to get as much, we want the information to be accurate. So they're going to have to provide us with the statements that show how much they paid for it. So when you buy stocks, you'll get a statement that confirms your transaction. It says that you bought 1,000 shares of Merck Pharmaceuticals at $38 a share. So hopefully they have that. So let's see, what do we have? We have the sale price. Let's see if we have all the information here. So she sold it and got $20,000. And here it says, these things happen. Her cost basis, she actually paid $24,000. So importantly, the fact that her cousin originally paid $26,000, that's like irrelevant. So remember, kind of sift through the information to see what's relevant and what's not. That's kind of interesting, but we need to look at her cost basis.
What about, since she bought it from her cousin, right? It's not a related party transaction? But then the cost of, the cousin's cost basis would carry through? No?
Not in this case. I'm sure that she would like that because that means that, well, in one way, in terms of being able to get the capital loss, but you're right, that's why this is a sensitive issue. Of course, why not say it was $26,000? Use that cost basis. But if this is a legitimate transaction and she actually paid $24,000, then the IRS said, well, that's the cost basis that we should use. So he also lost money, right? If he paid $26,000 for the Amber stock and he sold it to his cousin for $24,000.
He got lucky that instead of taking $3,000.
Yeah. So yeah, it's not ideal. It's definitely a little, shady, but that's the kind of clients you get sometimes. So she actually has a loss of $4,000. And then, what else do we know? What about, let's see, the stock? There's more stock that she sold, right? Let's see. We have the dates here. She purchased it December 5th. Was this one? What year was it, Janelle?
Then she
$35.
2005? Okay. And then she sold it,
November 8th.
No, wait a minute.
No,
That's
it's
your
November
Falcon
2008.
sound, right?
November 8th.
2010.
what was it, Shelley?
No,
Why
she
we-
started to
July
no.
2nd. Yeah, we're
That's
dealing with
correct, that's
Falcon.
correct.
Falcon.
Yeah, that's correct.
All right. And
She
then,
bought it on July 2nd, 2007.
No, that's the other one.
That's what we're dealing with.
so July 2nd,
Right.
2007?
2007, yeah. For 7,000.
All right, so how many shares? Let's see.
She paid 7,000 for the shares.
She paid 7,000, so of course basis is 7,000. And how much did she get, 13.5?
Yeah.
Oh, she made a little money here.
It was sold on December 1st, 2010.
What about the, so this is Falcon. What about Amber? What date did she sell that?
November 8th.
November 8, 2010.
What is it, 2010? Okay, so then she made 6,500.
65.
Which means her net long-term capital gain is actually 2,500. Alright, so the total, let's see, the total going up is 2,500. And she didn't have any short-term transactions, so the net long-term is 2,500. All right, did she have any, let's see, we put that in there? All right, so that's our capital gain. It's 2,500. 914, no, nothing, right? Let's see, IRA distributions, no. Pensions and annuities, no. And then, wait a minute, let's see, we got something for Schedule E, right? Let's see, what do we know about, how much? Distribution at 5,300, right? All right.